To another video of tradingsixter.com. In this video I would discuss about US dollar. I think you must be not aware of these facts and I hope you will find this video very interesting and informative. So, have you ever thought why the dollar always rises? Why the international trade is done in dollar? Why commodities like gold and oil are priced in dollars? You must have seen a line on the rupee note. I promise to pay the bearers the sum of 100 rupees. So what is the meaning of this line? And if you have idea of interest rate, you must be knowing that in India interest rate is 7% while in USA it's 0.5%. So why so high in India and so low in USA? All these things the reason behind these things we will discuss in this video. So we start by looking at the historical exchange rate of dollar and rupee. So you can see in this chart in 1974 the $1 was equal to 8 rupees, and over the years it has risen, and now it $1 is equal to 67 rupees. So why the dollar has always risen against the rupee in the longer term? Any currency is influenced by mainly four factors: the economy of that country, the politics of that country, the interest rate in that country which is set by the central bank, and this is a global factor which is geopolitics. And in this video I would discuss this factor only. In the longer term, this is the main factor which influences the currency. So to understand why the US dollar is always rising, we need to understand why the demand of US dollar is there. To understand demand, we go back in the history, and in 1940s, after the World War II, there was an agreement between the Allied countries known as Bretton Woods Agreement. The Allied countries accepted US dollar as reserve currency, and second thing, the US government pledged to keep enough gold to back its dollar. I will explain this point in a moment. Let's see what happened in that agreement. So basically all the currencies, all countries who accepted that agreement uh, had their currencies pegged with dollar. Pegged with dollar means they had fixed exchange rate with dollar. Like for example, $1 was equal to 360 yen, or $1 was equal to 0.3571 pound, UK pound. At that time, you can also see the euro was not existing, and each European country was having its own currency, and they also have a fixed exchange rate with the dollar. This exchange rate was agreed, and dollar was also having a fixed exchange rate with gold. So it was a pretty stable system because the currencies were pegged with dollar and the dollar was itself pegged with gold. So everyone had a faith in the system. You can see from this table the in the phase 1950 to 1970, the due to this agreement, the exchange rate remained more or less constant or stable for all major currencies. Also, now we understand what is the meaning that gold is backed by dollar, and this is the reason why this agreement was also this era was also basically this agreement was also known as gold standard. So you can understand by seeing this note. This is a $100 bill note, and this is during the era of gold standard. You can see on this note there is a line written $100 in gold coin payable to the bearer on demand. So what is the meaning of this line is basically this line means anyone having this note can go to the bank and exchange it for equivalent amount of gold. Like I told you, 1 ounce of gold was equivalent to $35. So anyone who is having $35 can go to the bank and ask the bank to give 1 ounce of gold. This is the meaning of this line. And same thing is written here also. And if you see the rupee note also, there is a line, I promise to pay the bearer the sum of 100 rupees. This also was having the same meaning. And this also started, this line also started during that gold gold standard era. So since the dollar was backed by gold, people have maintained confidence in dollar and the strength of dollar was maintained. One more thing, due to this agreement or due to this gold standard, any country can only print that much currency as much it had gold. So, for example, US is having 1 billion worth of gold, then it can only print $1 billion worth of currency, because if tomorrow everyone goes to the bank and asks for exchanging it for gold, the government has liability to give them gold. So they have to maintain that much gold. In 1971, President Richard Nixon of US abolished this gold standard, and dollar can no longer be converted or exchanged for gold. You can see in this dollar bill note, this note is of after 1970 era, and you can see that line stating that this can be exchanged for gold has now be not there. And also this is there is a new line there, this note is a legal tender for all debts, public and private. So what this line means basically is that anyone who is accepting, who is given this note for some payment, has to accept that this note for that payment, and this is basically enforced by the government. So after the abolition of gold standard, since it was no longer, the dollar was no longer backed by gold, people lost confidence in dollar because only it was guaranteed by the US government. So the US government needed to do something to maintain confidence in dollar, and so that dollar demand would so, would be there. So another thing happened during this phase. In 1960s to 1970, oil was discovered in the Middle East. So US was very intelligent. They knew that they need to do something to make demand for dollars. So what they did was they they utilized this opportunity. They opportunity this that oil was discovered in Middle East. The US went to Middle East countries like Saudi Arabia, and they did a deal with them that they the Sau- the Sau- the basically the Saudi has to sell their oil in dollars, and what would US give in return? US will provide any military assistance in case of war. So the whatever oil these Middle East countries were producing, most of them were exported, and they were now being sold in dollars. It was also agreed that the Gulf countries would invest their excess cash or reserves in US bond and debt. We will understand this point in a minute. Let's see first what was the impact of this agreement that oil will be sold in dollars. So earlier, suppose South this agreement that oil is sold in dollars is also known as petrodollar. So when if the if the petrodollar has not existed, then uh, any country who is buying oil can pay for oil in its local currency. Like for example, in this we are taking example of Saudi and India. So Saudi is a big exporter of oil and India is a big importer of oil. So India basically buys oil from Saudi. If this petrodollar would not be there, India could easily make a deal with Saudi to pay them in rupees, which is their local currency. Indian local currency is rupees, and they have no supply constraint for rupee. They can print as much rupee, and so they can buy as much oil they want. But after this agreement, since oil was sold in dollars, they needed dollars to purchase oil, so they somehow dollars need to obtain dollars from somewhere so that they can purchase oil. Now let us see how can a country get dollars. So the main ways are either the best way is to basically through exports. Exports can be of goods or services. Second way is to promote more foreign investment in their country. Third and final one is loan from foreign countries, which is not the best option always. So now we are just connecting the links and seeing how this agreement with the between Saudi and America to sell oil in dollars is now impacting rupee and dollar exchange rate. So first link was that to to buy oil any country requires dollars, and to get dollars any country would need to promote its exports. Now how can a country promote its exports? So the easy way to promote its exports is to make its local currency weak and foreign currency strong. I would explain this with an example. Suppose in this example we are taking US, which is a importer of goods and services because of it's having a huge demand, and it is importing from either India or China. So suppose it has $1 and it has to export a good which is worth $1 either from India or from China. So, and we also assume that initially the exchange rate is $1 is equal to 1 rupee and $1 is equal to 1 Chinese yuan. So $1 basically $1 can either both Chinese yuan and rupees are having the same exchange rate with US dollar. So US can purchase that good from any of these two countries since the exchange rate is same. Now tomorrow China in to promote their export devalue its currency. Now $1 is equal to 2 Chinese yuan. So when Americans would exchange their dollars, one thing you should note that when they are buying goods from these countries, they have to pay in their local currency. Like if they are buying goods from India, they need to pay India in rupees. Basically in rupees means the company who's exporting goods will ultimately convert that money received from US in rupees. So if the exchange rate is manipulated or changed, like in this case the Chinese government somehow devalued their currencies and now $1 is equal to 2 Chinese yuan. So Americans can exchange their dollar for more Chinese yuan. So they can buy more goods from China at the same price, means same $1 they can buy more goods from China. But and India, since it is still having the same exchange rate, so they can buy less goods from India at $1. So obviously they are getting goods from China at a cheaper rate, so they would prefer buying it from China. Now for India this would be a problem and their exports would go down. Now again to readjust this problem, to again promote their export, India would also devalue their currency to $1 is equal to 2 rupees. Only then India can remain competitive in their exports. So you can see from this example, every country is now engaged what is called a currency war. And currency war is basically every country is now devaluing its currency to promote its exports and to get dollars. Now you can understand the links. Any country want to basically want to buy oil need dollars, and to get dollars it need to do export, and to promote export it need to devalue its currency to make it exports more competitive. So this fact, this agreement that oil would be sold in dollars, you can see how it is impacting the currencies of various current countries. One more thing, if you see the Indian scenario, in India the largest exporting good or service is the IT services. India generally export IT services like softwares to the foreign countries. Also, the IT sector now has become one of the biggest employer. It employs a huge number of people. So, and one more thing, IT sector mostly receives its revenue in dollar and it pays its employees which are who are in India in rupees. So its income is in dollar while its expenses are in rupees. So to increase its profit, it either has to increase its revenue or decrease its expenses. So if somehow dollar buys more rupees, so it can easily increase its revenue. So to help the IT companies, government will always prefer to keep rupee weak so that they can increase their profit. You can also see that this is a live example. In 2008, dollar appreciated, means strengthened to a very high level of 39. $1 was equal to 39 rupees, and dollar was very weak and rupee was very strong at that time. At that time the IT companies started feeling the pressure, and they basically they pressurized indirectly the government to devalue the currency. So RBI stepped in and it purchased dollar from the market to weaken the rupee. And you can see after that there was another story that 2008 recession was there, and dollar strengthened due to that. But we can see from this chart that they the Indian government somehow sustained that 39 level. They didn't didn't uh, they didn't let the rupee appreciate more than 39 level. Now I will discuss the second point of that agreement, that was that Gulf countries would invest in their excess cash reserves in US bond and debt. So to understand this, we need to understand what is a bond. A bond is a debt instrument in which an investor loans money to an entity. So there is a bond issuer and bond holder, basically bond buyer. So bond buyer basically loans money to the bond issuer, and in return the bond issuer pays the bond holder interest, and in the end, at the maturity, the principal. So for example, if USA is the bond issuer and Saudi is the bond holder or bond buyer, then Saudi is loaning money to America, and USA is paying Saudi some interest and the principal at the maturity of the bond. So we understand another point, which is why any country may has to issue bonds. So any country, generally countries incur fiscal deficit. So what is a fiscal deficit? Fiscal deficit is basically the government is spending more than what's it earning. So government have some revenues, and government have some spending. Revenues come mostly from tax, and spending can be on military, health, education, etc. So whenever the spending is more than the revenues, the government is in deficit and it needs to borrow money. To borrow money, it issues bonds, and these bonds are bought by investors. These investor can be individual investor or some companies or even countries. So you can understand one thing, if the government is spending too much compared to the revenues it's generating, it needs to issue more and more bonds. And generally, if it is continuously incurring more and more fiscal deficit, then it would have a hard time finding the buyers for its bond. But in case of US, since there this the since of because of this agreement, there was no problem of buyer of their bond. They can spend any amount of money and just issue the amount bond for the deficit, and they would easily find a buyer, which would be the Middle East countries. Yeah. Also, one more point, since there is a buyer, the interest rate they would pay on that loan depends on the number of buyers in the market. If more and more buyers are there for their bonds, they have to pay less interest for borrowing, and if there is less buyers for their bond, they have to pay a little higher interest rate. But now after this deal, there was no problem of buyers. There were plenty of buyers for US government debt. So US can issue huge amount of debt at very low interest rate. And this explains this question. Why interest rate in India is so high while interest rate in USA is so low? There are many other factors also, but this is the main factor. One more thing happened due to this petrodollar. It made all other trade, international trade, to be done in dollars. So not only the oil, but all goods and services which are traded are now traded in US dollars. So any country would require to maintain a foreign reserve which will mostly be in dollars to prevent in to help in time of crisis, because if somehow the country does not have enough dollars to manage its export, then the central bank would step in and provide with the foreign reserve. This is a table taken from the RBI site. You can see from this table that RBI total reserves is around $367 billion, out of which $341 billion are in foreign currency assets, and mostly foreign currency assets are mostly in dollar assets. So how do any country boost its foreign reserve? They generally boost it by buying foreign currency, and by buying foreign currency it means buying US dollar. And how do they buy dollars? They don't buy in US dollar in cash. They basically invest in US debt, which is very liquid. US bonds are very liquid. They are very very highly traded, and one can very easily sell them off whenever they require money. So any country, most of the country foreign reserve are invested in US government bond. So you can just connect the links again. You saw that due to this pact, petrodollar, oil was sold in dollars, and oil uh, due to this uh, all international trade was also done in dollars, and due to this all countries needed dollars. To get dollars, all countries needed to promote their export. To promote their export, they a weak, need to weaken their currency. Secondly, every country need to maintain some foreign reserve for in case of any crisis. They will need this foreign reserve. And so via both methods, they are basically they are propping up the dollar and weakening their local currency. One more thing, people always say that you should buy local goods. It would help in promoting. It would help in the rupee to appreciate. Does it matter? Does the trade balance matter? Like you have seen in India, various Swadeshi movement is there, like you should buy local goods, you should not buy, you should boycott the foreign brands like Pepsi, McDonald's, etc. So would it matter if you boycott these foreign goods and buy only local goods? This this can be seen from the chart. This data, trade balance is the difference between export and import. Trade balance is equal to export value of export minus value of import. So if a country is having a negative trade balance, it means that it is having higher imports compared to the amount of exports. You can, in this example, again I have taken the example of US. You can see the US balance of trade. It Since 1970s it has turned negative, and now it's highly in negative territory, around 40 billion. It is negative. So US is importing 40 billion more of goods and services while compared to the amount it is exporting. So if that the case that US any currency would be devalued if their trade balance would be negative, then US dollar should have depreciated, but it is not the case, and US dollar has actually appreciated. So this argument that if you somehow manage the trade balance, you will you will be able to appreciate your local currency is also not true. And one more thing, even if some country through the managing their trade balance, managing their export and imports, somehow manage to appreciate their currency, then also that is bad for their export, and they have to again devalue their currency to promote their export, else they would lose their competitiveness. I hope you got the point. This is the summary. Due to the petrodollar, any increased oil demand would lead to increased dollar demand, which would lead to increased standard of living. And this is because increased dollar demand means increased US debt demand or US bond demand, and more uh, more debt demand means more US government can print money and spend that money. So increase standard of living in USA. So in this video only this much. If you find this video informative and interesting, you can subscribe to our channel, and you can also visit our site www.tradingshiksha.com. We have various courses for stock market trading. Okay then, thank you guys. See you again.